Welcome to the Gray Report. I'm your host, Spencer Gray. If you're a multifamily investor, active, passive, if you're someone that's in the industry, you're in the right spot. Every single week on the Gray Report, we're breaking down the latest research, data, articles, and original opinions from the Gray Capital team, but elsewhere also. We have an exciting episode for you today. We have Chris Salviati, the senior housing economist from Apartment List, is joining us today. Incredibly excited. Because if you are a consistent viewer or listener of the Gray Report, well, we talk about the great work that Apartment List does all the time. We use their research, at a high frequency. I think our last episode that we just released, we went into the June report from Apartment List. And again, they really kind of keep us up to date and can compare with some of the other data that's going on so we can really build a complete picture. So strap in, we're going to have a great episode. And let's jump in with Chris right now. All right, let's bring in Chris. Chris Salviati from Apartment List. Thank you so much for coming on the Gray Report. How are you doing today?
I'm doing great, Spencer. Thanks for having me on. Really excited to get into some of the latest data with you.
Absolutely. And again, like I was just saying, you and all of your colleagues over at Apartment List, do an incredible job. We, read all the reports that you put out, and we cover them at a really high frequency here on the Great Report because the data and the insights and the way that you guys parse the data is really good. And as the producer of the Great Report, Matt Bosnagle, and I were speaking in our last episode, you guys are also relatively transparent on your methodologies as well, which a lot of other groups is a little bit more of a mystery. And we've asked questions when we've had folks on, but you guys are on every single one of the pieces of the reports that you put out. Pretty clear on how this data is really being put together. So before get in, so I want to talk about supply, I want to talk about demand, but just give us, I'd love to hear a little bit more about yourself, your background, and what you do at Apartment List.
Yeah, thanks, and appreciate all those kind words about the research. I think that is one of the major goals that we try to do with our work, is really trying to take the data that we see and put it out there in the world, and democratize that to help folks kind of make better decisions on all sides of the market. And to your question, I've been here at Apartment List for about 7 years now, so it's been a good run. But my background is in economics. Before I worked at Apartment List, I spent a little bit of time working at the Federal Reserve, also a little bit of time in economic consulting, and I've been doing housing economics research here at Apartment List, as I said, for about 7 years. And as I said, our kind of goal is really to take the data that we're seeing at Apartment List, also take some of those publicly available data sources that are out there, but maybe folks don't necessarily know about, or that data is kind of difficult to access, difficult to parse. And we try to draw insights from that and make it as digestible and, as you said, transparent for as many folks as possible.
Yeah, well, you guys are doing a good job, and not only are we using your information, I consistently see Apartment List being cited in some, really kind of high level, academic or just other articles from whether it's the New York Times, but also a lot of great sources. And we'll get into this in maybe a little bit of different ways to look at rental data, and obviously like CPI is very different from the types of metrics that you use, but also just knowing, maybe you can comment this, I'm curious what your role was at the Federal Reserve and what you did there, just because that's always interesting. But knowing that the access to some of the higher frequency data especially was played a big role, especially during 2020, when there was an absence of sort of the normal data that was coming out, and seeming that the Federal Reserve is more open looking at all of the types of data, that higher frequency data, with again Apartment List as a key component to that. But just what was your role at the Federal Reserve? Just curious.
Yeah, so I was a researcher at the Federal Reserve, and I actually worked as part of the team that was doing the broad macroeconomic forecast that was going up to the FOMC when they were making those monetary policy decisions. So, really kind of looking at a variety of data sources, and that's a big team of folks that my role was kind of very specific. It's actually really interesting when you get into that. You've got folks that are a whole big team of folks that are forecasting very specific segments of the economy, and then that all kind of rolls up to a broad macro forecast. So yeah, certainly, I mean, inflation has been very top of mind for a while now, and the way that housing fits into that is definitely a very important and interesting part of the equation right now. So we can definitely get into the weeds on that. But from my experience there, I can definitely say that there's a lot of really smart folks there that are looking at all the different data sources out there. And so, housing is one that's really kind of interesting and very specific in how it factors into CPI. And we can talk about, how housing is measured in the CPI versus how it's measured in our index and the other real-time data sources. I think the folks at the Fed are kind of aware of those differences, and they are tracking the real-time sources as well. But it is certainly a very interesting time to be tracking all this stuff.
It is, because there's such a big divergence with what, again, kind of the market rate real-time data is showing, and then the way CPI is calculating shelter and owner's equivalent of rents. But so yeah, since we're just on the topic, but kind of before we jump into everything else, what is the difference in the way the Federal Reserve, looks at housing and how, again, housing is taken into account to CPI versus some of the other metrics that you might see out there, or that Apartment List might put out there?
Yeah. So I'll it's a little bit wonky. I'll try to explain it as simply as possible. We'll get a little bit in the weeds here, but I mean, first off, I'll just say that housing is really important to CPI. It actually makes up about a third of the overall index, and that I think makes sense, right? If you just think about the average household, your monthly rent payment or mortgage payment is, in the vast majority of cases, your largest monthly expense by a pretty wide margin. And so for that reason, when we're thinking about CPI, housing is actually the single biggest factor that drives overall CPI. And that's broken out into, owned housing and rental housing. The thing that I think is interesting and that a lot of people might not realize is that when you're talking about folks that own their homes, CPI isn't actually looking at what your monthly mortgage payment is. They use a concept called owner's equivalent rent. I'm sure many of your listeners are familiar with this. I think the general public, maybe not always as much, but
yeah, a little bit more now. But yeah,
for sure. Yeah, but the basic idea there is that they're asking folks that own their homes, if you were to rent that home, how much would it rent for? And that's what's being tracked in CPI. And so really, what's happening with the rental market is in a large sense kind of the primary driver of how housing is tracked in the CPI. Now, the big difference between what we're doing and what's tracked in CPI is that the Apartment List Index, and if you look at any of the other kind of real-time market indicators, we're looking at how prices are changing for new leases. So just folks that are signing leases today, how much would that new lease, that unit that's leasing today, how much would that rent for today compared to how much that same unit would have rented for a year ago? That's what our index is representing. What the CPI measure is tracking is how much prices are changing across all households. So not just folks that are signing leases, but really across kind of the entire housing market. And so because of that difference between tracking new leases versus all households, there's actually quite a big lag in what's happening in our index and how that filters into the CPI measure. The way you think about that is really only a small share of households are moving in any given month. And so that when you're looking at all households, those price changes just take a lot longer to filter through. If you our index is showing a cooling market right now, that's compared to 1 year ago. But for someone that maybe hasn't moved in, say, 4 years, if they go to try to rent a new apartment today, they're still going to be subject to those really big market rate increases that we saw in 2021 and 2022. So there are still households out there that haven't quite absorbed those big increases that we saw a couple of years ago, and that's why that is still showing up in elevated housing inflation as tracked by the CPI. And so, as I said, our index is showing things cooling off right now, but when you look at how it's tracked in CPI, that measure is still showing pretty heightened housing inflation. And right now, that's actually one of the key factors that's keeping the overall rate of inflation elevated. If you strip out shelter from overall CPI, I believe it comes out to maybe even under 2% now. So shelter is really kind of the main driver of heightened inflation right now. But as we know, the market rate rents have actually cooled off quite a lot.
Are you surprised, Chris, about the lag? Because I guess I understood that there'd be a lag between kind of real time, new leases being signed, which aren't representative of what everyone is paying right now, because that's just that lease that's signed at that point, at that time. But I've been a little bit surprised, and you're way more of an expert than I am. You're actually an expert. I just play one on YouTube. But I've been surprised at how long that lag is. Are you surprised, or is it doing what it's supposed to be doing?
I think it is a little bit surprising that it's taking this long, that lag right now. Traditionally in some of the previous cycles, we've seen a lag of something around 12 months. Our index really peaked in late 2021, and the CPI didn't peak until middle of last year. And now that kind of bottom to bottom looks like it's extending to be a longer lag as well. And so I think the lag is definitely taking longer than myself and maybe some other folks who track this stuff closely would have expected. But I think the thing that's important to call out here is we're also just talking about a shock to the market that's a lot bigger than things that we've seen in the previous cycles. And so I think, because the swings have been so extreme, it's just taking longer for, the CPI to sort of fully metabolize that. It's headed in the right direction. The CPI measure is cooling off, but it's just taking a little bit longer than I think a lot of us would have expected.
Do you anticipate, the OER to actually ever go negative? Or do you think it'll always stay somewhat positive?
I don't think it'll go negative. We're not necessarily expecting that. Our index has dipped negative. Our new lease rent index has been negative for actually about a year now, slightly negative, and we can talk more about that. But again, just because of the differences in methodology that we talked about, those kind of swings up and down, the extremes are generally less pronounced the way that it gets tracked in CPI. And so, I think we will expect that eventually that should get into the very low single digits, but I don't think we're expecting it to necessarily go negative.
Yeah, I think that makes a lot of sense. So, speaking of, apartment lists, the latest report that came out looks like the nation saw about 0.4%, month over month rent growth with negative 0.7% year over year rent growth. So, again, positive for, in the short term, but, relatively still sluggish relative to some of the seasonal growth that we would expect. These numbers surprising to you, or kind of just tell us anything more about kind of the most updated kind of the rent growth numbers that you're seeing?
Yeah, for sure. I mean, I think the way that you just characterized it is spot on. We are seeing rents trending up right now. Month over month rent growth has been positive for the past few months, but that upward growth has been very sluggish. It's really kind of just inching up. And actually, when we look at the month over month growth rate this month, that's slightly slower than what we were seeing last month. And that's a little bit at odds with what we typically see with the seasonality in the market. Right now is generally the peak moving season. That's normally when we see the fastest rent growth in the year. Right now, we're seeing rent growth, even though it's positive, is actually dipping down a little bit compared to where it was a couple of months ago. And as you said, that's kept the year over year rent growth rate negative, where it's been for basically a full year now. And so we've definitely been seeing a sluggish market for some time now. I mean, it's hard to say whether or not it's surprising. I think, I probably wouldn't have expected that our national index would have remained in negative territory for the year over year rate this long. But also, we are seeing this huge surge of new inventory that's in the construction pipeline and is hitting the market. And so I think kind of two things are true. Demand is starting to rebound a little bit compared to, where it was a year ago. But at the same time, there's just so much new supply coming online that I think it's really hard for, for absorption to fully keep up with that. And so that's keeping rents soft. And it's also important to keep in mind, too, when we talk about this, that we are coming off of these couple of years, 2021 and 2020, first half of 2022, where we were seeing rents just go totally bonkers through the roof. And so even though our year-over-year growth rate has been negative for about a year now, we're still only about 2% below the 2022 peak. And at the same time, we're about 23% higher than we were at the start of 2021. So some of this is also just kind of a little bit of a come down after that period of wild growth, pendulum swinging back a little bit. So in that sense, I think it makes sense to me that, after a period of the market, overheating to that extreme, that we would see a little bit of a cool off.
I didn't say it would almost be hard, especially as an economist, to imagine a scenario you would see so much above trend growth without some sort of reversion. Not necessarily to the absolute mean, but some sort of reversion, and especially as you just mentioned, in the face of an incredible amount of new deliveries and supply coming online.
Yep.
And two articles of Apartment List just recently talking about the new supply coming online. I think we're at a 35 to 40 year peak in new construction. And in a sense, I guess, are you maybe surprised that we aren't seeing more of a drawdown or negative growth because of the new supply, and that we're kind of reverting off of that high growth? It's a little bit off. It's not positive, but I guess in context, I guess you're surprised that the market is relatively stable.
Yeah, I mean, I think a lot of it does come down to what's happening on the demand side, right? I think the supply side, we actually can do a pretty decent job of forecasting. We see that permits data coming in, and that's a reliable data source, and then we can, to put it in kind of overly simplistic terms, you take permits and you kind of extend those out 24 months, and you know how much new supply is coming. Obviously, it's a little bit more complicated than that, but in some sense, we have good data on the amount of supply that's coming in. The demand side is where it's a little bit more of an X factor, and so I think the reason that it hasn't cooled off more is because demand has actually rebounded a little bit. If you go back to where we were late last year, consumer sentiment was really low. A lot of folks were fearing that there might be a recession around the corner. And at that time, it looked like, if that recession, for example, had come to fruition in the first half of this year, then we might be talking about things a little bit differently. But given that the economy has remained pretty healthy, and a lot of those, even I should say too, a lot of that recession fear was in some sense at odds with some of the economic fundamentals. I think we went through a period there where, a lot of folks were kind of using this term vibe session, where, if you ask economists that are looking at the fundamentals data coming out every month, we would say, actually, the economy looks like it's fairly healthy. But if you ask kind of the average person what their perception of the economy was, folks would say, oh yeah, things are terrible, there's a recession coming. And so, I think a lot of that kind of general perception of the economy was driving really soft demand last year, as we've kind of seen inflation not come fully under control, but certainly compared to where we were a year and a half ago, the inflation picture is looking a lot more positive, while at the same time, the job market has remained pretty stable. And so I think some of that attitude about the economy has really stabilized, and that's led to demand bounce back a bit. And so I think because we've had that demand bounce back, I think that's been enough to kind of offset this, pretty historic amount of new supply that's been hitting the market. The other thing I'll say there, and I'm sure we'll get into this as well, but there is definitely some serious regional variation in these trends as well. And so even though our national index is only down about 1% year over year, there are markets where we are seeing, more significant rent declines, especially some of these Sunbelt markets that are really building really, really quickly.
Yeah, and I see Austin, which was, one of the top ranked growth leaders just a couple of years ago, really has been suffering as of late, and not due to demand, because there's still an incredible amount of job growth, net in migration. But I think, they're looking at negative 7% plus, year over year negative rent growth, which is very hard to absorb. Getting back though, the cause is new supply in the deliveries. And because you guys feature a couple of different charts, showing the direct, correlation between, new units being delivered, as a relation to existing inventory and, rent growth. Talking about how it's easier to forecast what that supply is looking like. I guess in your research, and can you tell us a little bit about, what the next couple of years looks like or may have in store, because we've heard stories about a big pullback in deliveries, but at the same time, permits are still kind of where they were, pre-pandemic. They're not too far off. So, to me, it doesn't look like they're gonna fall off a cliff. But you've been digging into this. Well, what's your take over the next couple of years in terms of supply?
Yeah. You bring up a couple of really good points there. I think it's an interesting situation where a few different things are true. So, one, there has been a pretty sharp pullback in the number of new multifamily projects that are pulling permits. That peaked in 2022. There were over 700,000 multifamily units permitted. That number fell by about 15% last year in 2023. It's on pace to fall by at least another 10% this year, potentially more. Those monthly permits numbers have been continuing to trend down. So we are seeing, on one hand, a really sharp pullback compared to a couple of years ago. But at the same time, that number from a couple of years ago was a decades-long high. And even after this pullback that we've been seeing, the current levels are actually still fairly robust by historic standards. Right now, 2024 is on pace to still issue more permits than the 5-year average preceding the pandemic, 2015 to 2019. We're still trending pretty solidly above that 5-year average. And so, we're seeing the pullback in activity, but it hasn't fallen off a cliff. There's still a fairly robust level of new permitting activity happening. And the other piece I think that is really important to keep in mind is, there is that pretty long lag between projects pulling permits and when those projects actually reach completion. And right now we're still in this phase where there's a huge backlog of stuff that's still under construction. Right now, there's about 900,000 multifamily units in the construction pipeline. That's a high going back to the 70s. It's come down off of the peak over the past 6 months. Completions have started to outpace new starts, and so that under construction number is coming down, but it's still extremely high. And so as we work through that backlog, we've still got a pretty decent runway where we're going to see a ton of new supply hitting the market. 2023, we saw more multifamily units complete construction since the 80s. 2024 is on pace to see even more than last year, potentially significantly more than last year. I think there's a little bit of a question of, how this remaining backlog gets distributed between this year and next year. But in any case, I think we're going to see a lot of new supply coming for the remainder of this year into next year. And it's not going to be until kind of, I think, probably second half of 2025 into 2026 when the pullback in permits starts to filter down to a pullback in completions.
But the way I'm hearing you're describing it is, again, not falling off a cliff, but really just kind of getting back to normal, and not experiencing a surge. In your research, do you still see a similar distribution of new supply in kind of the same usual suspect markets like the Austins, the Phoenix, or has there been some diversification from home builders kind of since then? My gut is probably not, but have you seen any difference on where builders are building?
Yeah, we have seen. I would say it is kind of a continuation of those big Sunbelt markets that probably come top of mind. You named Austin. I think that's definitely the poster child market for this supply boom. Austin, on a per capita basis, has been uh, building more new housing than any major market in the country by a pretty wide margin and for a pretty long time now. I believe Austin has led the way in multifamily permitting activity for 6 or 7 years straight now, and has been in the top three for 10 plus years now. And so, that's a market that is continuing to build a ton. Raleigh, Nashville, Phoenix, Jacksonville, Orlando, all of kind of the usual suspect Sunbelt markets are really continuing to build quite a lot. I would say, really, most markets, though, even if they're not at kind of the top of that list there, virtually all of the major markets are at least have been building more over these past couple of years than they had been relative to their own, recent paths. And so, there has been kind of I think an uptick in just about every market, but the relative ranking of the places that are building fastest and slowest hasn't necessarily shifted too much. Seattle is maybe one that's kind of an interesting example that is sort of bucking the trend a little bit of the pricey coastal markets that tend to not build too much. Seattle has actually been building at a pretty healthy pace in recent years, not anywhere near the level of someplace like Austin, but doing a much better job of adding new housing than some of the other coastal markets like San Francisco or New York or Boston or DC or what have you. So I would say, though, really, when we talk about the supply boom, it is by and large a Sunbelt story.
On the topic of Seattle, and it makes me think of also the story of Minneapolis the last couple of years, another market that has seen really kind of a different trajectory as most other markets in the country. They brought on a lot of new supply, a lot of new relatively affordable supply, and then also they had some rent control measures that also maybe limited some investment, but they've experienced, really, slow rent growth. And from an investment standpoint, it especially during 21 and 22, when every other market was growing and Minneapolis wasn't, seemed like an issue. But from a renter's perspective, it's great because rents have stayed low.
Yep.
As an economist, the last several years have to have been interesting as several case studies of really the true impacts of supply and affordability and seeing this divergence. Because rent control has been a hot topic nationally for decades, and with, I'd say, many economists saying that it's they're good intentions, but there's unintended consequences through rent control, and really building a new supply is the best and maybe even the only really solution to have more stable rents and pricing. Just curious on your thoughts of what we've experienced over the last couple of years. Seeing all this new supply and is kind of testing that thesis, because I think a lot of people were really kind of skeptical of that idea.
Yeah, it has been, as you said, I think a really interesting time to be watching these developments play out, and to see these pretty unprecedented shocks to the market. I think has really given us some pretty interesting examples, and the regional variation has provided some good case studies. I think a few things to touch on here. I think in the case of when we're talking about rent control, as you said, I think a lot of that is kind of, those are well-intentioned policies. I think in some cases they can be very important in helping long-term residents kind of stay in the markets that they've long called home in situations when things are changing really rapidly. But but rent control alone, I think it can serve a purpose that can be quite important, but that isn't in and of itself going to solve a broader affordability crisis. If you just think about it in the simplest Econ 101 framework, if you've got heightened demand and you don't have supply that's coming in to meet that demand, then prices are going to go up. And I think that's what we've seen in a lot of markets that have had rents increase really rapidly, not just in recent years, but over the long run. It's a situation where you've got really strong local economies. You've got lots of folks kind of coming in for good jobs, really high demand, but not a lot of new housing construction to meet that demand. And so prices go up, housing gets really unaffordable. That's been, and when we talk about some of these coastal markets, places like San Francisco, New York, Boston, like these are issues that haven't, they haven't happened suddenly over the past few years. Certainly the past few years have been quite extreme in terms of the big swings that we've seen in the market. But the markets that are seeing the most acute affordability issues, these are problems that have built up over the course of decades. And now what we've seen when we look at over just kind of these past few years, I think this big supply boom has offered a good case study where we are seeing a really clear correlation where the markets that are building the most are seeing rents cool off the most. We talked about Austin as being kind of the prime example here. Austin ranks first for most multifamily construction. Austin also ranks first for the sharpest rent decline over the past year. Prices there down 7% over the past year. And 7%, if you're looking kind of over the long run, as you said, it's not too long ago that Austin was kind of at the top of the list for fastest rent growth. And so, that 7% decline isn't necessarily erasing the longer term increases. It isn't erasing the affordability concerns of long-term Austin residents, but 7% is not an insignificant decline in a single year. Yeah.
No. Yeah, no, I'm just thinking if I was buying a multifamily property in 2022, again, no one assumed negative rent growth. Certainly not negative 7%. It was some sort of positive assumption to compound off of. And, I've done enough, modeling to know what, 1 year of negative growth could do to the compound of that eventual, number in return. So, from the investment side, so definitely, certainly is going to throw major wrench in the gear of a lot of owners. Now, but to your point, if you purchased that same asset in 2019, 2018, and you experienced that run up, well, you're not happy, assuming you didn't refinance and pull all of your equity out. But if you kept owning and you experienced that probably, the 30-some% rent growth that Austin experienced over a period of time, that the reduction of 7, you can certainly survive. Just curious, you're based out of San Francisco, and you brought up San Francisco. It's a unique market with a lot of different dynamics that are going on. And I love the Bay Area. I wish I'd been able to spend more time there. I've been there, half a dozen times or so. Great experience. There's a lot of challenges I know in the Bay Area as well. It used to be known as some of the highest rents in the country. You're seeing some of the highest rent growth. Every time I would go there, I'd pull up apartment list or whatever listing service, just because I was curious. Tell us what's going on kind of the San Francisco multifamily and real estate market, just from your own experience.
Yeah, the Bay Area has been a really interesting example. I think it's actually maybe been one of the most unique markets over the past few years. San Francisco, as you said, has long been the most expensive housing market in the country. We, in the first year of the pandemic in 2020, actually saw the biggest rent dip of any large market in the country, as a lot of folks kind of went remote with their jobs, and were questioning why they were paying some of the most expensive housing costs in the country if they could now do their jobs from anywhere. And I think because the Bay Area is so heavily concentrated in the tech economy, those jobs are the ones that are most likely and easiest to go remote, and so for that reason, I think the Bay Area has kind of been most heavily impacted by this shift toward remote work, and that's something that has that has been lingering. Rents have bounced back a bit from that dip in the early phase of the pandemic. But if you look over the full period since the start of the pandemic in 2020, San Francisco has had the softest rent growth over that full period, and year over year right now, rents are still pretty soft here. So it's a little bit of kind of a unique situation because we're also still not building a ton either, and so it's a case where rents are still relatively soft, but it's coming more from the demand side. Whereas, when you talk about some place like Austin, that's a market where demand is still really strong, but there's just been so much new supply that's leading to soft growth. Whereas in the Bay Area, there still hasn't been a ton of new construction. And when you look kind of over the long term, this is still a part of the country that has a serious housing affordability issue. And it is still one of the nation's most expensive markets. It's just that kind of the delta has shrunk a little bit. If you're comparing the Bay Area to, say, Phoenix, for example, well, San Francisco is still a lot more expensive than Phoenix, but the gap between San Francisco and Phoenix has actually shrunk by a really meaningful amount over the past few years.
Yeah, no, that's true. The growth in Phoenix has been pretty incredible. Are you seeing some of those workers coming back to the Bay Area? Folks moving back in, or getting more reports that CEOs are saying, "Hey guys, come back, get back into the office."
Yeah, definitely. I mean, I think that pendulum has started to swing back, but I think it's been swinging back a little bit more slowly here in the Bay Area than maybe it has in some other markets. I think, as you said, the Bay Area is it's also just a beautiful place. It's got a great culture and has a really, that kind of tech industry is so strong here. We're still a major hub for that. And so I think kind of long term, there's always going to be folks that are going to want to be based in the Bay Area. The companies are going to want to be based here. And so I think, long term, we are seeing it rebound here, but it's been maybe a little bit slower than it has in some other markets.
Any other markets that you've seen be kind of interesting to note with any kind of unique characteristics?
I mean, so I guess a couple things come to mind there. One would be just when we talk about that Austin example, I think I would just call out that, Austin isn't the only example of that impact that we're seeing of new supply on prices. It's actually the case that when we look at, the list of the top 10 markets for multifamily construction and the top 10 markets with the sharpest year-over-year rent declines, there's huge overlap. Seven of the 10 markets appear on both of those lists. It's Austin is kind of the most extreme example, but also Nashville, Orlando, Jacksonville, Phoenix, San Antonio. A lot of these Sunbelt markets that are building really, really quickly are also seeing, meaningful rent declines over the past year. And so I think, when we talk about that impact of new supply, Austin's not alone there. We see a really clear correlation. And I think it is really interesting and important to call that out, because I think, the supply boom that we're seeing right now is offering a really interesting case study of that. And then one other thing I would say, that this is maybe a little bit on a slightly separate thread, but one kind of couple of sets of markets that are on the other end of the spectrum, the markets that are actually maintaining positive rent growth right now, is a lot of the Northeast and the Midwest is maintaining positive rent growth. I think the Midwest is kind of an interesting example. That's a part of the country that didn't necessarily see rents go through the roof to the same degree as some other parts of the country, but has actually been more of kind of a slow and steady maintaining positive growth. And then when we talk about the Northeast markets, it's actually some of the more secondary Northeast markets that are seeing some of the fastest rent growth. Places like Providence, Rhode Island, Hartford, Connecticut. I think some of these peripheral markets have been actually really interesting examples as well. So
yeah, I know. I saw some of those, and even Portland, Maine, and some of those northeastern markets have seen really substantial growth. Which some of the reason behind that is some being more supply constrained, relative to kind of NIMBYism and just, hesitant on future growth? You'd say at least in the Northeast. I don't think probably not that in the Midwest, but
Yeah. I think in the North, yeah. So those two regions, I think there's a little bit of differing trends going on. In the Northeast, I would say most of the major markets in the Northeast are still very supply constrained and have extremely high housing costs. And so what I think we're seeing in that part of the country is a little bit of a flight to some of these secondary markets because they do offer, better affordability, at least right now. And with these kind of shifts to remote work, even though a lot of folks have been asked to come back into the office, a lot of folks are maintaining hybrid flexibility, even if you have been asked back. So, that commute from Providence to Boston, maybe if you were doing that 5 days a week, that feels a little bit long. But if you're doing it 2 or 3 days a week, that feels completely reasonable. And so I think that, that's been another big factor that's accelerated some of this flight that was maybe already happening from the really expensive hubs into the more affordable secondary markets.
Curious your take on the Midwest. We're based in Indianapolis, and so it's a region obviously we cover quite a bit. We have a lot of anecdotal experience and data all the time, but we've started seeing some trends shift and are probably hyper aware of what's going on. But I'm just kind of curious on your take. Not from an outsider, but just an outsider of the region, kind of your perspective on what's going on in the Midwest.
Yeah, and yeah, definitely curious to hear if my take aligns with your kind of more boots on the ground perspective. But I think, as I said, it's been the case that when we just look at our rent data, pretty much all of the markets in the Midwest have been maintaining positive rent growth at a time when national rent growth has dipped negative. Not significant rent growth, but healthy kind of low single digits rent growth. And I think what we are seeing is maybe a little bit of sort of what I just described in that Northeast dynamic, the flight from kind of the expensive hubs to the more affordable satellite markets. I would maybe say kind of telescope out nationally, and the Midwest is kind of the region that is sort of the example of that. You've got, I think, really the Midwest is sort of the last bastion of housing affordability now that most of these Sunbelt markets have really gone crazy. And so I think you are seeing, renewed interest in some of these Sunbelt markets from folks in other parts of the country because housing affordability has just become so much of a challenge virtually everywhere else. And a lot of these Midwest markets are actually, seeing pretty healthy economic growth. A lot of these markets are offering pretty good job opportunities, and so I think the fundamentals are there to, I think, see pretty good demand in the Midwest going forward.
You did a good job. It was good summary. We're seeing quite a bit of a lot of new jobs coming on. The reshoring and really resurgence in manufacturing is really exciting to see. Tons of semiconductor foundries, battery plants. So it's really cool to see that resurgence kind of in Midwest manufacturing, combined with affordability. In Indianapolis, we have folks coming down from Chicago all the time just because sick of paying Illinois state income tax. And we'll see how those trends progress over time, and if we kind of revert back to seeing most of that growth in the Sun Belt with all the population growth, and more just kind of slow but steady growth out of the Midwest, or we see kind of above trend growth, over the future. Well, Chris, one last question. This has been an awesome conversation, and I want to invite you back on the Gray Report the next time you have availability, because
I'd love that.
Great insights. But just because not that this was what you did at the Fed, and not that you have the answer, but just curious, giving your insights into the housing market, which you said is the truth. It's such a large component of CPI. I'm going all the way back there, but from your take, just curious on your thoughts on further potential interest rate cuts this year on the Fed funds rate. If and when the Fed will cut, given your insights to how the Federal Reserve works and your insight into the housing market, which, as you said, is such a major driver in the economy and inflation right now.
Yeah, that's a great question, and I wish I had the crystal ball on it, but
Yeah.
as we all do, I'm sure.
I've got to ask though.
No, of course, yeah, and I think so. So my take on it is, look, inflation has come pretty well under control compared to where we were, a year and a half ago, but it's still running hotter than the Fed wants to see. A lot of that does have to do with this lag in how housing factors into CPI, and I think the Fed is aware of how all that works. They are tracking the real time indicators, and so I think in some sense a little bit of that kind of heightened CPI that we're seeing right now is really driven by that lag, which maybe isn't as relevant as some of the more real time indicators. I think the Fed knows that. At the same time, I think the economy is still running a little bit hotter than what they would like to see, and then what maybe some of us would have expected at this point. And so I think those rate cuts, they're definitely still coming. They're on the horizon. Whether or not they're coming this year, I think it has become a little bit more of a question mark. I think a few months ago, I think we were feeling pretty confident that we were going to see rate cuts starting in 2024. I think now it's a little bit of a toss-up. I wouldn't be surprised if we do see rate cuts before the end of this year, but I also wouldn't be at all surprised if that doesn't happen until 2025.
Yeah, I think we're on the same page. I've got my dartboard. I've got January penciled in for whatever reason. I think it's like a round number. I think it's like 18 months since the hike started. So it's literally, I'm like, it's a round number. That sounds like what the Fed might.
I like it. Yeah.
So, yeah. Well, Chris, again, really thank you for your time coming on the Gray Report. What's a good way for folks if they want to follow what you're doing? What's the best way to get in touch with you or follow your work?
Yeah, for sure. So I would point folks to check out the Apartment List Research blog, apartmentlist.com/research. You'll find all of our reports there, our monthly rent report. So we update that every month and make all of the underlying data available on the blog as well. That also updates every month. So for folks that are interested in really getting in the weeds and doing their own analysis, we've got all the data up there, as well as all of our kind of ad hoc research reports as well. So that would be the best place to go check out the stuff that me and my team are working on. And if you ever have any questions about any of that, we're also available by email at research@apartmentlist.com. That goes straight to me and the rest of my team. And, we always love to kind of answer questions that folks have about our data and analysis. And I always love chatting about this stuff.